Hello and welcome to the September edition of Amundi's Market Review. Over the summer, equity markets continued to creep higher and credit markets showed further easing tension with spreads tightening. There are several reasons for this. An overall improving COVID-19 situation in the United States in particular, low inflation expectations and low rates, which are positive for the equity markets and the economy, stronger than expected earnings reporting season for the corporate sector, and the perception that policy boosters will remain in place for longer than initially expected. Since our last review early July, several things happened. Europeans achieved political agreement on the recovery fund, central banks committed to supporting the economic cycle, preserving easing lending and financing conditions. On the other hand, geopolitical risk increased in certain regions, the emerging markets in particular, Lebanon, Turkey, Belarus, just to mention a few. The US-China dispute moved on renewed tension. In the meanwhile, Brexit talks continued to stall. The overall impact was positive on the markets. The S&P 500 drifted higher more than 12% since the end of June. The US dollar depreciated almost 6% versus the euro. Oil moved back to $43 per barrel. Gold posted a 10% gain because of negative real rates continuing to decrease in the US. Can real rates move further lower? Possibly. But what happened in the rest of the world? Equity markets have been positive since the end of June, but on much lower increases. Before drawing conclusions, though, it is important to mention that in the United States, equity market is highly polarized, with almost all the performance has been registered by the 5 big companies. So where do we stand now? Some good news come from the Eurozone, where the funding needs for the area are almost covered. This means that ECB will have less pressure in case of an economic emergency, while interest rate yields and the volatility of spreads will stay low. In general, we expect the current trading range for US and Eurozone interest rate to be maintained. Entering September, we expect economic growth to be more gradual and flat moving forward, as the fastest path to the rebound is already behind us. At the time of recording, we are seeing a rise in the number of infections in Europe. It is likely related to the summer tourists returning back from holidays, but also due to the fact that testing has been ramping up significantly. This back-to-school September period will be a key test in this respect. We would like to conclude with 2 takeaways. First, this scenario for the last part of the year is going to be more uncertain. Although the world today is more prepared for a second wave of the pandemic, when we look at the medical treatments or the policy reaction function, the global recovery stays fragile. Second, financial market conditions are becoming more and more similar to what they were before the COVID-19 crisis hit in February. High valuation and some areas of complacency. Many sectors are far from recovering to pre-crisis level. Many companies have been supported by state guarantees, and at the same time, debt in the system has been ballooning. It's time to be prudent. Thank you for listening. Please keep safe and see you next month for another market review.